All right, kind of along the same lines we're already talking about a little bit. Since the recession, U.S. large companies, large growth companies, the what we call FANMAG, Facebook, Amazon, Netflix, Google, Apple, Microsoft, the FANMAG stocks have really driven the market. Not only were they driving the market before COVID, but their business model, their product, their services were perfectly suited for a shutdown, work from home, rely on technology type environment. And so they've really been gaining significantly in their stock price. We don't think that's going to continue forever. In fact, we think that foreign stocks, specifically emerging market stocks, are a little bit better prospects going forward from a valuation. Now, not all companies, but some emerging markets from a valuation, dividend yield, and growth prospects. So we're going to want to understand that those companies that have been leading the market the past few years may not be the ones going forward. We also think possibly the value companies, your energy, your financials, your industrials, may take over some leadership of the market away from the technology, consumer discretionary type companies that have been leading the market. The same thing, our smaller companies in the economy, while they've been doing okay, and they really started taking off the latter part of last year, we think they'll do better this year also than your large technology companies. So we want to make sure that we're not looking in the rearview mirror and expecting what happened the past decade to continue the next decade. I just don't think that's a realistic estimate. Energy is still a massive need in the economy, whether it's old-fashioned, oil, coal, natural gas, whatever, versus clean energy, your solar, wind, battery power, those type of things. The energy sector, the globe still runs on energy. And as the economy is recovering, the energy markets will as well. Like I said, whether it's traditional, clean energy, they're all going to recover, and they're still down from last year. So we think there's going to be definitely some growth in there. I'd like to mention, I'm going to be talking a lot about what's happening. I think it's really important that people understand what's happening, just like, technology, or what's happening with energy, or what's happening in the US versus foreign. But I'll caution you to what we call tilting your portfolio away from or towards something that you think is going to happen can be a dangerous thing. There's nothing wrong with a slight tilt based on what's happening in the world or trends that are happening. But to bet your portfolio and to make these massive tilts, we're not recommending that. I just think it's important that people understand what's going on, what to expect. It doesn't necessarily mean that you need to go run out, or we're not going to go run out and all of a sudden massively change someone's portfolio. For one thing, if it's a taxable account, as we're going to talk about in our next video, taxes are a huge burden on that. So I think it's just, I talk about this stuff to let you know that we understand what's going on. You need to understand what's going on, and we will adjust the portfolio as we see fit, but we're not going to make massive changes based on something that we think is going to happen. Okay. Let's talk about corrections. Look, the probability of a correction in 2021 is frankly the same as it always is. Generally speaking, there's going to be at least a 10% correction in the stock market every year. You just got to expect it. Sometimes, some years, multiple corrections. Now, we have seen volatility come down, reduced volatility, which is good for stock returns. It also reduces the prospect of these corrections. But if you're investing in stocks, you got to expect it, and you can't time it. It's going to appear when you least expect it. Similarly, we think a decline of 15, 20%, there's a 50-50 chance that'll happen this year. If you look back at history, about 50-50. As you get into 25, 30, 35, 40% like it was last year, that's a 1 every 5-7 year event or so. But certainly expecting a 15-20% decline in the market this year is perfectly reasonable. We think the odds of that are probably a little higher in the second half of the year. The first half of the year, we don't think it's probable at all. But as I always say, you got to expect that to happen. It doesn't mean the end of the world, doesn't mean your stocks are going to become worthless, but you just need to kind of expect it. Okay, so now let's move on. Let's talk about bonds. Kind of the same theme here. Interest rates are really low right now, and we expect those low rates to continue for quite a while. And so that's going to lead to low bond returns. If interest rates start to creep up, it actually hurts the bond returns. So we're not expecting a tremendous amount of return out of the bond market anytime soon. Same thing here, low inflation, low interest rates, all those things are going to drive continuing low returns in the bond market. Same as the stock market. There are some tilts that we like to see. We do think there is some benefit to what we call the credit premium, meaning risk above treasuries. So treasuries are still considered the safest bond investment. They just don't pay hardly anything. And so we like to tilt a little bit towards high yield, some emerging market bonds, give a little bit of extra return. We think it's worth the little bit of extra volatility. We also want to continue to see some foreign bonds in the portfolio. Now, with our bonds, we like to hedge them. And what does that mean? It means that the dollar fluctuation up and down in stocks, the returns of stocks are high enough that it can absorb that fluctuation return. But the bond market, when your returns are 1% or 0.5% or something like that, the currency fluctuation on that return, you're going to wipe out the bond return, and you're going to end up essentially with a currency return. So if you invest in a foreign bond and don't hedge or strip away the effects of the difference between euros and dollars or yen and dollars, if you don't strip that effect away, you're going to end up not with a bond return, but with a currency return. So all of our bond investments, we like to hedge those returns. And while we don't expect foreign bonds to return better than the US like we do foreign stocks, we do still see a diversification benefit in those foreign bonds. So what do we see? We see 1%, maybe 2% as the year goes along, 1.5% on the US aggregate bond market. We think on high yield, we can add another 1 or 2% to that and get into the 3, maybe 4% returns. But that's it. For your high quality bonds, you're looking at 1, maybe 1.5% by the end of the year. Not a lot of returns. The high yield premium is there, as I said, maybe 1.5 to 2.5%. It's not as high historically. So on those high yield bonds, you're not going to see 7, 8, 10% returns like you have in the past. Bond market returns will be low. Did I say that already? I'm going to keep saying that. Bond market returns are going to be low. There's not a lot of return to be had in the bond market, but the diversification benefit is still there. We still believe that bonds have a place in most people's portfolio. Maybe if you're younger, more aggressive, it's fine to reduce that. We don't look for bonds for a lot of income. That's not why they're in the portfolio. We know that. They're in there as a stabilizer, as a risk mitigation factor. And so far, they're still doing a great job of that. In COVID, markets declined. They did a great job of doing exactly what they were supposed to as a stabilizer and risk mitigation factor. But they're not in there for return. You need to look elsewhere for that type of return. Dividends. We like private real estate for income. I'm going to do a whole video on real estate, but suffice to say for now, the fixed income is not a lot of income. We expect what we call the term premium, meaning how much additional return you get from a 1-year bond versus a 30-year bond. We think there's some marginal difference. We have a very flat yield curve right now, meaning there's not a lot of difference between buying a short-term bond and a long-term bond. That curve has been steepening a little bit. We expect that steepening to continue through 2021, but not to a tremendous degree. And so we still like the shorter end of that curve. If interest rates do go up, if you're on the short maturity type bonds, the increase in interest rates does not hurt your bond portfolio as much. So we're going to try to keep it on the short end of things. TIPS, Treasury Inflation Protected Securities. These are government issued bonds that automatically give you an extra return based on what the rate of inflation was. They had a great year last year in response to possible unanticipated inflation. A lot of people started buying TIPS. The Federal Reserve started buying TIPS. I think it's they own probably 15-20% of the TIP market right now, and they're looking to increase that. But when you want to own TIPS is before there's inflation. They respond really well to unanticipated inflation. So we're going to keep TIPS in our portfolio. We like them to hedge the risk of inflation, but we don't look for the returns like we had last year. We got 10, 11% return out of TIPS. We don't expect that for this year, but we do like them to continue holding them in the portfolio to help protect against that unanticipated inflation. Okay, so that's about it for the bond market. Did I say we expect low returns from the bond market? Okay, great.